Golden Rule Radio is brought to you by McIlvaney ICA. ICA has been helping people take delivery of precious metals and find storage options for decades. They have also helped thousands of investors with their precious metals IRAs. Call ICA today for your free portfolio review at 1-800-525-9556 or download your free report online by clicking the link in the video description to learn how you can double your gold and silver ounces even within an IRA.
Welcome back to Golden Rule Radio, your weekly precious metals market recap and outlook. And unfortunately, there's not a ton of activity this week. You know, we like to run through this volatility and price movement at the beginning of each show, and yet, Miles, not a whole lot of action, exciting news to report.
You
I don't
say
even see charts in front of
unfortunately.
you.
You say unfortunately, but I think it's unfortunate for one of us and very fortunate for the other, because there's a different discussion we can certainly have today. So we do want to take a minute and at least, as we always do, glance at what's going on in the precious metals market, but it doesn't require much more than a glance if you've been catching the show for the last couple weeks. So brief wrap up, big move up in gold, just in case anybody missed that last year. For those of you just tuning in for the first time this week, gold took a huge move till August, and then we've had this long, prolonged 2 steps forward, now 1 step back movement, which found what could be a bottom here a couple weeks ago, down just under 1,700, we hope. So we're seeing exactly what we expected to play out. Gold has taken a nice bump up. Silver has been putting in these higher lows and higher highs. We just put in another slightly higher than the previous one low down here at this fib level you can see on the chart. So the next step up probably could put us back well above 30 if we do end up pushing higher. So little break point this week in silver. Are we higher? Are we lower? But as far as gold goes, it's doing exactly what was expected. Platinum having a little reversal after putting in that 6-7 year high. Palladium, again, big breakout move. But we talked about a lot of this stuff last week. So I think the one big thing to bring up this week is the dollar, which we'll look at here in a second.
Yeah, I think it's worth repurposing some of last week's charts because those numbers have not changed. We haven't broken out of any of your channels. We haven't fallen through support or broken up above resistance. So let's throw some of the same images
I'm not that lazy.
up.
I am going to make new charts for this show. They're just going to look, like you said, very similar to last week.
But it really is. I mean, there are headwinds with gold, and we're up today as we're recording on Wednesday afternoon. And in fact, gold has, in this week-long period, outperformed silver despite silver's relative strength. So the ratio has actually climbed to just under 69 to 1. And remember, a few weeks ago, we got as low as 62 to 1. And so we're actually starting to see silver be a little flatter even than gold in this time period. But all that to be said, I think one of the headwinds is the dollar. So let's jump into that because here we are sitting at 92.6 as we record on that dollar index.
Yeah, and here Wednesday, nice little jump up in the dollar. And, you know, Robert, who's not with us this week, but Robert's been begging for a nice little correction back up here, just following his trading patterns in the U.S. dollar, and it's been real lackluster. You have this much downwards movement in the U.S. dollar, you'd expect to see some type of reversal back up. Now, fundamental standpoint, obviously the dollar's going down.
Yeah, and you say this much dollar downward movement. I mean, we got down into the high 80s. We're up about 4 points on that, about 6%. And so that 6% jump is big. But prior to that, remember, we were coming down off of around 102 and came down all the way to around 88.
Yeah, and that's what I mean
that's
by
what
a
you're
lot.
talking about.
Yeah, I'm not talking about the last week. I'm talking about really since we hit that peak 104 a couple of years ago. Attempted to get back up to that high, failed, put in a lower low, and then, like you said, just came down strong. With dollar down, 13%, I think, overall?
Yes. And here, as of late, the dollar strength has coincided with the bond market. So you're seeing another headwind being the bond market, aside from some of the other things that just garner attention from the gold investor, things like digital currencies and a hot stock market. But outside of that, you've got the bond market and the dollar commanding a lot of attention and creating headwinds for gold. And despite that, this show, we tend to focus a ton on the technical analysis, and rightfully so. We want you understanding entry points, maybe even exit points, depending on what you're looking to do. And all that to be said, underlying fundamentals drive a lot of things. News drives, right? But we have to break the listener of this show from a trader mindset. I was talking to one of our advisors here today, Jeff, and he just brought up this brilliant point of reminding his clients to not be looking at this as a trading type of approach. We can analyze technically for entry and exit points and that sort of thing, but we need to have an investor mindset. And an investor mindset is somebody who's investing in something for the long run, macro, big picture, total portfolio planning type of stuff. And that's where the physical precious metals market comes in. We aren't day traders. We're not out there trading in our life, in our professional life. And so all that to be said, it's worth reviewing those fundamentals. So let's take a step back because one of them is the dollar. Let's get into this dollar chart.
Yeah, the dollar is the perfect example of that technical versus fundamental discussion because we're fundamentally in a dollar going to the floor universe coming forward. I mean, in the first month of a new president, we added 7% to our national debt, 1.9 trillion into the 28 already outstanding. I don't see any slowdown of that coming anywhere in the near future. So it's not unreasonable that you're going to see the US dollar, which has been falling pretty consistently for a while, continue to do so. However, you're going to hit some of these trading levels where these day traders you're talking about, and it doesn't have to be day traders. It can be, say, longer-term currency traders like I do in my free time. Seeing some of these levels where you know you're going to have a lot of activity at that point and placing reverse trades, swing trades, in order to capture some of that gain. And you may hit it right and you may not. But the reality is you're going to see these bounces happen in markets just like we're seeing with gold coming down. Because same question on the flip side, right? Dollar's clearly in a very strong long-term decline. That's going to push other markets up. Dollars are getting less valuable as they're pouring more and more of them into the market. So the equities market is up, gold is up, silver's up, copper's up, oil is up, timber's up. The cost of everything is going up. That money's got to go somewhere, but you're going to have these day traders stepping in that are going to scrape profits off the top and look for re-entry points. Now, we're not here talking about that within the precious metals market to most people out there.
Just because that's not what we do professionally on a day-to-day basis.
Correct.
We're not trying to say don't do it.
No, because we're looking for where this ends up landing when it's all said and done. This is 2004, 5, 6 all over again. We're looking for that 2008 market crash followed by the 2010, 2011 commodity rise, where you see gold go from $400, $500, $600 around 2006 all the way up to $2,000. Well, this time we're not starting at $400, we're starting at $1,200. So you can assume a similar type of movement. Now, I'm not looking for places to get in and out and back in precious metals because I know when the wheels come off, you can't get back in. And that's the scary part for me. And we're starting to see that right now with what some of the premiums in precious metals are doing. Anybody trying to buy a Silver Eagle today knows that you're paying 30% above spot price just to get it out of the mint. So while we like talking about this stuff because we find it fascinating, and we do think we're trying to provide an opportunity for people who are trying to build these long-term positions from entry levels, and we will do the same on the back end of this. Look for opportunities to step out of portions of precious metals and say, go work with Dave McElvaney, who we had on the show a couple weeks ago over at the wealth management side of our company. While we're looking to balance on a macro scale how to build a portfolio, we're not trying to micromanage the day-to-day movement. So that's why I think it's important to get on the phone with an advisor. Say here, listening to the show every week, we're trying to do you a service, but it's 10 minutes.
I'll play advisor right now. In fact, I'm going to jump up on my soapbox here so that everybody can not only hear me, but you can see me when I say this. This is the mindset that you have to have. I get asked 50 times a day, what's going to happen to the US dollar? I get asked 50 times a day, what's the gold price going to do? I'll tell you what the gold price always does over time, right? It goes up.
Well, it does the opposite of what inflation does.
That's right. And the reason it always goes up is because we're operating in the world of a fiat currency, as Jeff pointed out today. So because we're in a fiat currency, it's like death and taxes. It's guaranteed. You are going to have inflation, which means you are going to have a depreciating dollar, a depreciating fiat currency. So we preach all the time that gold maintains its purchasing power over time. So here's a few examples just to refresh everybody's memory and encourage you a little bit as to why you always own X percent of your portfolio as physical gold. 1975, average price of a house was $38,000. That was 236 ounces of gold, because gold was $161 an ounce at the time. So we're talking 1975. Today, the average price of a home is $346,000, tenfold increase. Well, gold is at 1,735 an ounce as we record here today. We're not even talking about the high from 6 months ago. Well, that's 200 ounces of gold. And so what's interesting is, yes, it's not only maintaining its purchasing power of a home, it's actually increasing in terms of its purchasing ability. Gold has gotten even more valuable in that period of time with a home. All right, let's look at a car, and then let's look at some food. Car price back in 1975, $4,950. That was 31 ounces of gold would buy you a car. Today, it only takes 23 and a half ounces of gold to buy you a $40,850 average new car.
Is that what a new car costs?
Yeah.
That's what an average new car costs?
An average new car is $40,850. Now the bread, so we can add a little food component into this. Average price of a loaf of bread back in 1975 was 28 cents. And we hear Kevin talk about this a lot, not only on the commentary, but with his clients. That actually, back in 1975, you could have acquired 575 loaves of bread for 1 ounce of gold. So even more than a loaf a day for a year. Now, little did we know that they actually do track and have for decades the average price of a loaf of white bread in the United States, which now is measured at $1.54. That means that at $1,735 for an ounce of gold, you can buy 1,126 loaves of bread today. Now, you have to take into consideration that there's actually potentially been some forms of deflation in the loaf because it's Wonder Bread, it's processed, it's nasty.
Doesn't
matter.
Like
it was, right?
Big fan of simple carbohydrates.
Okay, there
here.
you go. All right. But all that to be said, in all three of those examples, not only is gold maintaining its purchasing power, yes, it's gone up tenfold, but so have the costs of all these things gone up even more than tenfold. That's the environment that we're set up for. What does the 1.9 trillion do? It narrows the gap even further. It means that it's going to take even fewer ounces of gold 10 years from now to buy you your primary staples in life.
Or what we can do is we can remove all the things that people actually buy from the measurement tools that the government uses to determine what the inflation rate is. And then it just doesn't matter anymore. And then gold looks like the worst investment ever, right? When you just factor it in based on...
Twist all the inflationary measures. That's right.
No, it's a great point because you really do, in the fast-paced, highly competitive financial scene that has been around for the staggering period of like a couple decades. Because there was a time in not too distant past where people actually invested in the quality of a company and not just what we think their stock price is going to do. But since we've changed that style of investing to this more aggressive common stock price focused investment model, we've sort of forgotten that there is something to be said for having an underlying strategy that encompasses multiple purposes as to why you invest instead of just the investments in particular.
Yeah, that's right. And going back, it's so boring. It's so simple. You can go back to 1975 or you can go back to 2000. The trend is the same. In both time periods, gold has outperformed the S&P 500, including right now. Measured today with gold at only $1,735, down $350 from its high in August. And the S&P arguably at its all-time high. Still has outperformed. So $100,000 invested in gold in 1975.
Drum roll.
Got you 621 ounces of gold. If you had those same 621 ounces of gold today, it'd be worth $1.1 million. That is asset growth nominally. But again, it goes back to what does it turn around and what does it buy? And if gold goes to $3,000 an ounce, which everybody wants to see in the next 5 to 10 years, guess what? That's representative of the dollar losing that much more purchasing power over time. Can we put it more plainly, more simply? That's why you use our charts, use our show for great entry points, find value, find discounts, avoid premiums. Let us advise you as to how to circumvent some of the realities of the market right now with true product cost. but add to your ounces every month throughout your life. It will not let you down.
And this brings us all the way back to where you started. Why do we do a show like this? Are we here trying to day trade, or are we here trying to build long-term habits that build real family and financial wealth over long periods of time? Because one thing I think that we've all faced is the FOMO, fear of missing out, when a market does start moving. So when we started doing the show a couple years ago, one of the main reasons we wanted to do this show for was to help bring some logic to combat against what we know is going to be a highly speculative, highly emotional market at some point in the near future. And as of 2020, we're starting to see it now. So what we're trying to do is to provide you logical entry and exit points which fall in line with our long-term thinking of what we feel the purpose of gold ownership is amidst the current bull market in gold, and when it comes time to do so, it will be amidst the current bear market in gold at some point down the road.
We talked in our staff meeting yesterday. A few years ago, we actually created a DVD entitled When Greed Turns to Fear. Right now, we have seen greed begin turning to fear. If you have your logical mindset and your well thought out plan of attack for your portfolio over multiple decades, stick to it. Don't fall into the trap of greed and don't fall into the trap of fear, because we don't know how things play out. But gold weathers the storm.
So that's going to do it this week on Golden Rule Radio. We appreciate you stopping by. If you liked what you heard, hit the subscribe button, ring the bell. You can find more info on our website at McIlvaney.com. We're also on Twitter at ICA Gold or Facebook at McIlvaney Financial. And as we mentioned earlier, often it's best to sit down and just spend some one-on-one time discussing your personal portfolio with one of the advisors here at McIlvaney ICA. We can be reached at 1-800-525-9556. Thanks for listening and have a great week.